Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today would typically be Mr. Michael Becker, the governor of Beckerville, but he is on another due diligence assignment with his group at SPI. Boy, those guys are working hard. They just never stop, do they, James?
They don't stop.
So, sitting in the podcast today, the professor himself, James Eng. James, thanks for being in the podcast.
Great. Thanks for having me, Paul.
So one of the things that we always want you to think about is if you go into the Old Capital Podcast website, take a look at James's webinars that he has done, and I think they're really outstanding. James, give yourself a little self-promotion of what that was.
I mean, essentially each one was about 45 minutes to an hour, and we really broke down three different topics. So we started with sort of non-recourse versus recourse, looking at bank loans versus Fannie Mae. The second one, the 202, was really around what's all the nuances for Fannie Mae. So whether it's prepayment penalties or assumptions, supplementals. And then the last one, 303, was really around timing. So once you get under contract, great, but now you got to close this thing in 60 days. And so how do you prepare for those 60 days? And then anything that you can do up front, the better. And so even while you're in the process, that is a great one to watch, just so that you know the steps that the lender is doing and the steps that you should be doing throughout a transaction.
So go to the oldcapitalpodcast.com. Also, too, is that if you go in iTunes, if you listen to us through iTunes, make sure you go to the Old Capital Podcast iTunes and leave us a 5-star comment. If you like some of the stuff we talk about, we would definitely appreciate a comment and maybe a 5-star review. We do appreciate that. So oldcapitalpodcast.com, and throw out a like for Facebook for us. We'd always appreciate that. So in the podcast, we have a multifamily investor. So I want to kind of introduce you to Satya Masina, and he's going to talk a little bit about, I'm going to call it money management. How does a guy start off in multifamily? How do you go from having a couple units to having lots of units? And so in the podcast today, Satya, we appreciate you coming in. Thanks for your time.
Hello, Paul. Hello, James. Thanks for having me.
So I'm going to kick it over to James, and let's talk a little bit about how did he do it?
So Satya, we met probably about 3 years ago, and we were walking a 30-plus unit deal in McKinney.
Yes.
I guess tell people, before we met there, what was your sort of real estate experience? Sort of what did you do day to day before that?
Yeah. So I've been working in IT corporate for the last 19 years. While I liked doing what I did, I've always wanted to, build a business. So been analyzing a lot of franchises, small businesses, and I must say it's mostly, all those years, it has been paralysis by analysis,
Yeah.
and then, not taking action. But coming to the real estate, probably what got me started is that I must say, I've been an accidental landlord.
Okay.
So I lived in Dallas from 99 to 2003, and I had to move up to Jersey from 2004 to 2008.
Okay.
So I had a townhome, I bought a townhome to live there. So it was in South Jersey. So end of 2008, 2009, we wanted to move back to Dallas, Fort Worth, and we actually moved, and we listed my townhome for sale. And it didn't sell.
Okay, this is 2008. It's 2008.
2008.
Okay. Yep.
So you know the time frame. But after 3 months of waiting, I listed the property for rental.
Okay.
And it rented out immediately.
Okay.
So from then on, I liked the rent check coming in every month, and I was able to manage it remotely. So I like the concept of getting that check. It's not that I'm saving a lot on that, but the property was paying for itself.
Okay, good.
So probably that triggered me off looking into real estate investments. Initially, I was looking at maybe commercial, So after considerable research, I was able to figure out that with the money I had, going and buying big retail strips is out of question. And I also came to the conclusion that single family is not going to cut it. So, for me, luckily, I skipped the whole single family thing. And finally, in 2014, I started off with 2 fourplexes.
Okay, so those 2 fourplexes, so you owned those for a little bit. How did you find those?
That was, that was the time, where I was struggling to find a commercial broker. But I found these fourplexes on a regular MLS,
okay.
Realtor.com.
And so that realtor sort of helped you find those deals in 2014. And then now in 2015, you're like, I'm looking for something bigger. And did they find this 37 unit or was it just listed? How did you find the 37 unit deal?
No, I think I was searching on things like LoopNet.
Okay.
And while you don't find any good deals right now, on places like LoopNet, but at that time I was lucky, I did find that property on LoopNet, and I had my residential broker represent me on that transaction.
Okay. And so let's just talk briefly about that first transaction. If you can tell us maybe sort of roughly sort of what you paid on that deal and then how long you owned it and sort of a little bit about that transaction.
Sure. It's a 37 unit. I like the location. As they say, location, it's in the growth part of McKinney, very close to downtown. But honestly, for a first timer, the condition of the property, the characteristic was that it had multiple buildings with different sizes and so on. But I liked the location a lot. I mean, it was 95% occupied. Okay. The in-place cash flow was good. So we paid about 1.4 million and we held the property for 2 years, did a lot of rehab. In fact, we haven't taken any cash flow because we were putting everything back into the property. So just little under 2 years, we sold it for about 165% return.
Okay.
Yeah.
And then, so it was just on that particular deal, you decided to do a 1031 after you sold that deal.
That's right.
And then what properties did you move the money into from there?
So the 1031, at that time, we went and bought 3 different properties of a total portfolio of 87 units.
Okay.
We could have bought one single property. At that time, we didn't find the right sized property, but also partly it was also intentional, considering that we are investing our own money. Primarily it's me and I have one partner, Ramesh, who invested with me. We were cautious, we wanted to diversify into, we didn't want to take risk on one single property. We were still new.
Okay.
So it was more of a conscious decision as well to go into multiple properties.
So on that McKinney property, because of the condition of the asset and just sort of where it was in terms of the rents were under market, we decided on just like a bank recourse loan for that one.
That is
But
right.
then when you moved into these 3 other properties, we went to Fannie and Freddie.
That's right.
And so you were able to get, non-recourse debt on sort of stabilized properties. I guess how has the experience been sort of, we originate a lot of loans. Maybe talk about how is it working with the lender in those, in terms of servicing and all that type of stuff. Is there anything that's different or what have you seen?
Absolutely. So when I first started with the McKinney property, the entering into the commercial loan world, was tough because we struggled to start off. And luckily, we contacted Old Capital. And of course, James, you remember, I think you did the first loan. We just didn't get the loan, but we also got a lot of education in regards to, at that point, learning about recourse, non-recourse, what it means. We learned all that through World Capital, our journey. And then, of course, we, from 2 bank loans, we jumped into executing 3 Fannie Mae loans simultaneously.
Right.
And it was intense.
All in like November and December and January. Yeah. So it was a busy time. Yeah, I remember that.
And it was, pretty intense. There's the big difference between a bank loan versus Fannie Mae loan. But what I gather is that bank is your partner and they're providing you a non-recourse loan. So of all the things that they're asking you, you kind of take it as, oh, wow, this is a lot of stress. But we took it in the terms of they're your partners and they're actually doing a lot of due diligence, for you. So while the paperwork is intense, I think we got it done, with Old Capital's help. And
they're putting 75 to 80% of the money at close, right? So they're making sure that their investment is in safe hands. And so you close those 3 properties, and then you also, at the same time, how many units was the deal out in Farmersville that you purchased previous to that?
So when I sold my 8 units and I moved that money into Farmersville, it's a 24 unit deal. It's priced at $1 million. We invested about $250,000.
Okay.
So we bought this in December 2016, and we sold it, I think, end of June or July this year.
Okay.
So in about 18, 19 months time frame.
All right.
And we did pretty good there, almost over 200% ROI on that as well. Yeah.
So now you're looking at placing that money into a 1031, similar to last time.
Exactly.
And I think one of the interesting thing is when you're buying, so the total purchase price on Farmersville was $1 million. And so you really didn't have the option of doing Fannie or Freddie, and you really had to use a bank recourse loan. Is that you have the option to exit quickly. On that Farmersville property, how did you turn it so fast in 18 months? What was sort of the 2 or 3 things that increased the value of that property so much?
Sure. I think, if I can jump back into the bank versus Fannie. Now, I mean, in the hindsight, after acquiring the knowledge, there would be definitely, I mean, even with my latest transaction. So, it's not always that Fannie Mae loan is good or bank loan is bad. It depends on what property you're buying and what exit strategy you have. So what worked out for us both in the McKinney and Farmersville, they're deep value add properties. So we were able to turn them around quickly by rehab, bumping up the rents, increasing the value, and we didn't have to pay a lot of prepayment penalties while exiting the property. But coming to the 3 Fannie Mae properties, at that time, the thought process was also that we wanted to balance between value-add properties and stable income-producing properties. So we wanted to kind of hold them maybe a little longer than our previous 2 properties.
So you're almost like a little REIT. You have some cash-flowing, stabilized, long-term properties, but then also as you see opportunities in the market to buy something that's a little bit more hands-on, and you can improve the value quickly, then you'll do maybe a bank recourse loan.
That is correct.
Fix it and then sell it. And then, I mean, I think on the last 2 properties that you sold, the people were able to do Fannie and Freddie loans on those properties. So you improve the cash flow significantly. You have good financials throughout the last 12 to 18 months that people can underwrite to.
Yes.
Because a lot of these properties, when you bought them, they didn't really have any financials or limited financials. And I can't even remember some of the rent rolls that we saw. Yeah, I mean, a lot of them, nobody was using Resman, nobody was using any of these property management software to be able to give me a clean rent roll on any of these deals, right?
Exactly. On that note, James, what I would like to say is that so far we bought smaller 30, 40 unit properties from independent owners. And what we learned is that we want to buy smaller properties, but we want to think big. What we learned is that most of the independent operators, they don't have proper documentation to begin with.
Sure.
So when they put the property on market, it's definitely a negative because, nothing is transparent and they're struggling to provide reports. Whereas we learned quickly, and we also formed our own property management company.
Okay.
And we implemented a Resman similar to what the big property management companies are doing. And we realized how cheap it is to Yeah, it's the time and effort, but from a cost perspective, it's not much to implement RESTment.
Okay.
And then now we can produce professional reports, transparent financials. So when we sell our small property, we are acting like big players.
Sure.
So taking
a professionally managed property.
Yeah, exactly. Yeah.
Okay. And then so just to finish that Farmersville story, you 1031 into 2 properties. So tell us about the 2 properties that you just closed on in the last month and a half.
Sure. The 2 properties, again, one is a 24 unit in Wiley,
Okay.
value add, and we thought it's good to go with a bank loan on that because we think there's a good value add play, and then we can exit out of this maybe in a year or couple of years.
Okay.
And now we've also acquired another 34 unit in Princeton, which is again another booming town, and it's in great location. Again, it's also a bank loan. On any of these, if we want to keep them, we might later refinance into a Fannie Mae loan or exit out of it. Yes.
So both of those, I'm looking at a map here, are both of those in Collin County?
Yes.
So sort of east. So if you think about Dallas going sort of northeast, up 75, out that direction, then you run into both of those eventually.
That's
and
right.
So a lot of the growth that, Dallas has experienced, people are getting pushed out a little bit further than Plano, getting pushed out further than Garland and, Richardson and McKinney. So I see both of those as sort of growth areas. And I think, so you went under contract 2 months ago, and then the Princeton property, what was announced right next to your Princeton property?
There's a 289-acre mixed-use project coming up, literally, walking distance from this property. We like that a lot. We knew that Princeton was growing. We didn't know the specifics on this development, but it worked out pretty good. And also, I would like to say, as a small player, it's hard to kind of pick and choose your locations. But we've actually been deliberately avoided the too crowded infill Dallas market because there are a lot of players out there.
Okay.
So we consciously looked in Collin County and lucky to have found some of the properties that we found.
Yeah, we were actually just at a Marcus Millichap thing yesterday, and they said that there was probably from 2010 to 2015 there was a big push more towards the urban core, and what they're seeing people now is sort of the shift back to the suburbs.
Sure.
So a lot of the people who they're 30 to 35 and they're starting a family, starting to have kids, that generation, instead of being in the urban core, they're going out to the suburbs to rent places. So what would be interesting is, as a deal sponsor, a lot of people are having issues winning deals and finding deals. And so twice now you've sold your property and then been under pressure to find something within 45 days, or at least identify something in 45 days and then close within 180. How have you done that? Like, how'd you go from 2 properties to 5 properties and close all these deals and identify all these deals when some people are just trying to find one deal?
Well, what I would say is that definitely, real estate is as everybody say, it's a team sport. In regards to what I said earlier, we're buying smaller properties, but we act professional and we think big. So I think for us, one of the core asset, I would say, is the team. On the lending side, it's Old Capital, and on the listing or in regards to the real estate brokers, we've been working with Marcus Millichap. So we've had good relationship with them. They knew that we are knowledgeable, we are serious, and they were not afraid to bring us the off-market deals.
So these were off-market deals?
The
Okay.
off-market deals, yes.
Okay.
So they felt comfortable to bring us those deals, knowing that we would be serious and we would close them. So that's how I think it's the key to kind of keep looking, be persistent, do what you say.
Do what you're going to say, what you say you're going to do.
Yeah.
No, that's absolutely right. And now, as you built a track record of closing 6 or 7 transactions now, these listing brokers recognize sort of your ability to close, and you're not going to sit there and nitpick on things. And I think that goes a very long way, because when they're calling all these owners of properties that are looking to possibly sell, a lot of times if you get the first call, then that gives you that ability to execute.
And also what I learned is that probably brokers like 1031 buyers, because they know funds are there. And also I think for buyers out there, I think being specific is important. If you say you want to buy between 50 to 150, that's a big range. So we tell them okay, this is what we can buy and this is what we are looking for, more specifics and things like that. So you don't want to be all over the place. So I think being specific also helps, so that they can bring you the right fit and they think of you, when that fit comes to them. Yeah.
So right now you're self-managing your properties. If you were to move into a bigger, let's say 100 or 200 unit property, how do you think you would approach buying something like that?
Obviously I didn't start thinking that, do I want to syndicate or want to be an independent? I didn't have the knowledge then. But in the hindsight, what I would say is that I don't mind starting similar to how I started. So you need a good foundation to build a skyscraper. So I wanted that, I like the operational aspect of it. Like we now understand the B and C tenant demographic, what their limitations are, what their requirements are, their psychology, what can you expect, while you're operating the properties. So I think with that background and, few the full turnarounds, under my belt, I think scale can be achieved very soon. There's a lot of knowledge or, resources out there, it could be mentoring clubs, investor clubs, education. So I'm ready to, take on the scale. I think, the only thing we have to plug in is, again, bringing in investors, constant networking, putting myself out there, and similar to what we've done, being transparent with the investors and finding the right fit. So I'm pretty confident that, in the next year, I think we will definitely bring the scale that's needed to our operation.
I always like asking this question because I'm like a habits type of person, but is there any habits or things that you do sort of, all right, so in the next 3 months, what are the things that you're going to do to really push yourself to find a deal of size and really go out and do that? Any habits or things that you do sort of either daily or weekly?
Again, I think it's all about constant education. You cannot say, your past performance does not guarantee the future success. So you have to be out there, do your part in regards to analyzing the properties. Sitting before a computer and reading stuff is one thing, but being out there in the field, looking at properties, talking to brokers, various professionals is the key. And, obviously observing the trends, with the interest rate growth, recent spike in the property valuations, and of course, networking, building your database. So I think more than the habits, I think I've not actually had this, but I've developed the attribute of now what I really feel is that you have to keep the ball moving every, single day. There will be times that you won't do anything because you're digesting the information, you're struggling to make a decision, but you can't sit there for too long. So you have to, keep the ball moving every day, to make some progress. And that's what I've kind of developed over these 3-4 years, where be decisive, persistence, and then act on the knowledge you acquire. I think most of the times, including me, in the past, that you sit on the knowledge and don't act on it. So
yeah, one of my favorite books is Seth Godin, and he writes about, one of them is called The Dip, and he talks about sort of the long sort of slog through. And when you moved to Dallas in 2008, 2009, it took you a while to just sort of buy that first, 8 units.
That's right.
And now you've gone from 8 units to your first 37 unit in 2015, but then now you've taken that 37 units, and now it's
145.
Yeah, 145 units across 5 properties. And so you've definitely accelerated sort of where you were, right? From that first townhouse in New Jersey.
Exactly.
And so I guess imagine if you had never, what if you had sold that property and you would have never received that first rent check from New Jersey?
Exactly. Yeah.
So it definitely is a constant learning, education, but then also your ability to really get out in front of brokers, in front of investors, I think is key. And when there's a deal on the table, I mean, the thing that I like about Satya is that he'll send me a deal and I'll review it. And the next thing we know, like I'll give him some feedback, but then he works diligently at closing the deal, not in terms of just once he's under contract, but going from that initial walkthrough to really working with the broker, understanding sort of what the seller needs and being flexible and being able to get the deal under contract. And so a lot of people just cannot, that negotiation part where, I mean, we work with some people and, you know, they'll make offers on every deal on the market. And you got to narrow down your focus.
That's right.
To sort of focus in on what you can actually close. So understanding sort of what's on your balance sheet, understanding what you can close, who's your partners that you need to bring in is key, because on a lot of these deals, there's just too many deals on the market and the brokers are just going to forget about you unless you really put some deals together and close on them.
Exactly. I mean, on any property we make an offer, we take that pretty seriously. You know, I strive to be known as a closer because it's a small world of professionals. Like, you know, you mess up on one transaction, you know, everybody's going to know it. And also, you know, primarily we respect other people's time, because when we put an offer, like, you know, it's you're giving me a loan quote, which means that you're spending time on it, brokers spending time on it. There are like a lot of other people spending time on it. So, I mean, there will be definitely scenarios where we might have to back out, but we want to do our due diligence upfront and minimize that risk. And
right. You know, we usually like to ask our investors if there's any sort of advice or what sort of words of wisdom you can share, or funny stories you have. Sort of, you've bought a couple deals now. Anything that you'd like to share with the audience?
I recall I think more than the 8 unit, the 37 unit, I recall walking the property with you, James. We have seen all sorts of conditions and, you know, taking that first step and you're thinking that, oh, I'm going to, you know, dump 1.4 million into this property, and you can easily turn around and you know, go back. But I think, you know, realizing that money can be made there, and it's all about turning the property around. In regards to the, you know, even, you know, a lot of people think that rehab, you know, all that stuff, but also, you know, in regards to the property management, you know, just being consistent with your message with tenants, like, you know, setting precedents when you take over a property, all these things help. As far as funny stories, you know, the one thing, you know, while, you know, I'm a small operator, but I've not actually, you know, held the keys. You know, initial on the 8 unit property, I interacted with my tenants. I think more than funny, you know, what I would say, you know, I won't do certain things, but what I also enjoyed is that coming from corporate IT world, and my wife is a physician, you kind of realize that how blessed you are, and your social circle is, you know, is at a certain category. But now you're learning, you know, and interacting with the workforce, and you feel like, you know, how privileged and blessed you are. And I like stepping out of that corporate world and getting, you know, little dirty, you know, with doing things and in some rough encounters and things and so on.
Yeah, I mean, it's definitely a feel-good business, and especially with the properties that you've bought and sort of rehabbed, it's definitely, the tenants have felt that, right? So whether it's the new interiors or updated exteriors, I mean, the ability to go in and improve the property significantly is a huge difference.
Sure,
And
absolutely.
it's something that, you know, on, let's say, the McKinney property, I mean, yes, you had to raise their rents to justify it, but then there's really nothing else on the market in that submarket for them to live in, right? And so you not only gave them good product, but it was a good price.
But what is truly satisfying is that I think both in McKinney and Farmersville, I've had single moms come up to you and ask, "Are you the owner?" And then now you're not sure what to say.
Depends what time of the acquisition it is, I guess.
and then they're saying thank you. We haven't seen this property being taken care. I've been here for a long time, so. When you do something to the property, give them a quality unit, the rent growth is the side effect, I would say. So
some of the things that we started off having this conversation about money management and how well you've done. You've gone from 8 units to 37, then you worked your way up to 140 some doors right now. So that's fantastic. But some of the things concerning money management, when I think about money management, I think about really going to the casinos. And I hate to play blackjack because I always lose, but there's some sort of money management is that when I do win and I maybe win a chip or two or whatever it is, I put it in my pocket. And I always try to play with the house's money after that, and I don't care if I lose that. So the biggest thing that I kind of got out of you in terms of money management is having great financials on properties, like being you're an IT person, you're kind of a checklist. You're probably an Excel person that you kind of know all this stuff. But you said how important it is, and James reiterated that, of having a seller provide clean, accurate financials instead of a shoebox full of receipts and not having everything put together that you can actually see it. So I think that if you're a seller of some of these small apartments, have good financials because it will absolutely help you sell at your property at a higher price. If you come to me with a shoebox full of stuff, I'm going to kind of put that in the box of a distressed asset. So I'm not going to give you maybe the highest price to the property. Number two, one of the things you said I think is very important versus bank versus Fannie Mae, again under money management, up front, know what your exit is and what the costs are going to be. That if you do choose, a fixed rate for a long period of time, a non-recourse loan, that's going to come with a yield maintenance penalty, like a kind of a large prepayment penalty.
Exactly.
That's good for somebody who's going to live in the property or own the property for a long period of time. Maybe not so good for somebody who's only going to own it for 18 months. So know your exit. So maybe a better idea is to do a bank loan, a recourse bank loan. If you have a comfort level with the property, do a recourse bank loan. And then when you're out of it in 18 months, you're going to have a small prepayment penalty or no prepayment penalty. So that's money management up there. And then having money management, having the brokers know, like you went from 8 to 37 and you used exchange money, and then having the brokers know that you're an exchange buyer. Like that's an important thing because you have only a certain amount of days that you have to reinvest this money into another property. And so a lot of other buyers, maybe small syndicators, that they have to go out and get the money to put into the deal, but you already have the money. So you're a legitimate buyer that has to do something fairly quickly, and that you're not out there looking at 10,000 deals. You're looking at 5 or 6 deals, but they know you're going to be making an offer on these deals because you got to place this money or you're going to be taxed a big number. And so you are probably more of a legitimate buyer with an exchange. So getting the word out to some of the brokers out there that you are an exchange buyer absolutely helps you in the way that you do things. So success comes with money management, and you're kind of proving up to me that you're using your money management skills to be as successful as you have become.
Absolutely, Paul.
Well, that was a great recap. And Satya, is there anything else that maybe we didn't touch on that you wanted to tell the audience, or just maybe let them know a couple ways or the best way for them to reach out to you if they have, maybe some questions about a deal, and sort of take it from there?
Sure, James. I can be contacted at my email, Satya, SATYA, P as in Peter, Masina, MASINA @gmail.com. So satya.p.masina@gmail.com. So again, I think I'm, average Joe. So, I don't think, just being persistent, gaining knowledge, I've transitioned into something, from an IT world into real estate, and I feel pretty good about that. And I think, anybody can do it as long as you have the motivation and the will to do it. And of course, learning from other people and so on. And yeah, I wish to take this forward, go into bigger deals with syndication and, use my experience into transitioning into much bigger properties.
No, it's been great. A lot of success. So really appreciate you coming in the podcast.
Yeah, I remember the first time we got on a phone call together. Do you remember that?
Yes, I do.
That was a couple of years ago, and so I'm very happy for your success, and you're a hard worker. There's no doubt about that, and you've done a good job. So congratulations, and James, we appreciate your help putting his team together and him buying more properties out there.
Thank you, Paul. Thank you, James.
All right. Thanks a lot, guys.
This is Paul Peebles. Have a good day. Thanks.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.